All right, so this video is about step 8, which is a pretty easy step here. The best way to think about the post-closing trial balance is to reflect on the adjusted trial balance that we made, and then think about what changed with our closing entries, because the financial statements didn't alter any of our accounts. Remember, with the financial statements, we were just, in some cases, combining accounts. For example, we combined accounts receivable and the allowance for credit losses, subtracted the credit losses from our accounts receivable. We subtracted accumulated depreciation, netted it from our historical cost of equipment and land to get net PP&P. So we combined some counts, others we just brought straight over. But it didn't change any of these numbers. The closing entries that we made only applied to income statement accounts. If we had had any dividends, those would have been included here as well. And then an income summary account, which we created, but then immediately closed out in this final line to retained earnings. So what changed was all of our expense accounts, right, our revenue and gain account, because all of those were set to zero with those closing entries. They were all set to zero, closed into the income summary as income increasing accounts, income decreasing accounts to get the net loss. We then closed that net loss into retained earnings, which altered our retained earnings number. So when we are working with a post-closing balance, really the only things that change are retained earnings and all the accounts listed afterward. If there were dividends, they would either be listed right after retained earnings or after all the income items. So they too would. So basically, the rule of thumb is for a well-ordered adjusted trial balance, the only things that change on the from the adjusted to the post-closing balance are all the accounts from retained earnings down. So I'm really just going to concentrate on that because all of these, cash, common stock, wages, all our liabilities, assets, and equity accounts, except for retained earnings, can come straight from the adjusted trial balance. They did not change during the closing process, so there's no need to worry about any of their balances shifting. Right? From here down is where we have some changes. And notice I really shouldn't even put these in here because they would have been zeroed out. Sales revenue is now zero. Cost of goods sold is zero. Wage expense is zero. Gain on sales zero. I copied and pasted the unadjusted trial balance, and so these came with it, but they would be zeroed, or you could just again just leave them off of it entirely because they're now zero. The one that really changes is this retained earnings account, and it has a new credit balance of 293,736. That's the amount that we put on the balance sheet and the amount you would find here. You can fill out the rest of this and then total debits and credits to make sure that they balance, but they will. And it doesn't seem like a huge extra piece of video should be dedicated to that pursuit alone. I did want to return briefly to our financial statement lecture note piece, financial statement fundamentals, and just talk about the statement of cash flows. Now, the statement of cash flows just provides those changes in cash over between balance sheet dates. So we have our end of the prior year, end of the current year, and the change in cash is determined through the statement of cash flows. Cash is a very important asset for the company. We cannot pay our bills without cash. We can't pay them with our accrual earnings, right? If we have provided products and services on credit and have a ton of accounts receivable, that doesn't do anything to pay my bills until I actually collect cash from those individuals. So the statement of cash flows gives us that. And it breaks the cash flows in and out of the company between operating, financing, and investing activities. So let's talk a little bit about each of those. in turn. So the operating activities are any cash inflows from ordinary transactions in the business model. So any cash flows from ordinary activities within the company's business model. So their business models dictate what they do, and these cash flows are from those activities. Notably, it is something that does include interest payments, even though interest payments seems perhaps more related to financing flows. It would seem a little bit more like a financing flow because if we borrow money, that's financing the company. But these are all of our operating activities. So when we make sales that are cash, that's an operating activity. When we pay our employees, that is pay our rent, pay our insurance. When we collect cash from credit customers, that's an operating cash flow. So there's a lot of, cash flow from operating activities. This is the section that under the indirect method, you have to have it requires us to have an income statement and a balance sheet because what we're going to do with an indirect method is determine what our cash flow from operating activities is. So it requires an income statement and balance sheet. And the way that we determine our cash flow from operating activities under the indirect method is by taking net income and stripping any accrual income from our net income. Once we strip accrual income from our net income, then we have cash-based income. So what is accrual income? For example, if I made a sale, this might seem like a weird term to you, accrual income. If I make a sell on credit, that increases my accounts receivable with a debit and credits sales revenue. Well, the credit to sales revenue increases net income, but did I actually receive any cash flow from that? No, I didn't. I got another type of asset, which is accounts receivable. This is an accrued revenue because it doesn't result from cash flow. It results from those accounts receivable. So this is an example of something that we would need to adjust in our net income. And the process is a lot more complex than that. I don't need to jump into it. You're not going to be held responsible for it. But I do want you to know that the indirect method requires the income statement and the balance sheet because we need to take that net income for the period from the income statement and some information from the balance sheet in order to strip away these accrual income transactions from net income. Get rid of all the non-cash items that are in net income, and what's left should be our cash flow from operating activities. Investing activities deals primarily with acquiring PP&E investments and in intangibles. In regards to investments, that could be ownership of another company, um, through just a minor holding, a majority holding. It could include any common stock we hold of other companies. That would be a minor holding. It includes tangibles that we purchase. It includes PP&E that we purchase. And of course, the selling of those items when we're done with them and dispose of our PP&E, our investments, our intangibles. That creates cash inflows. So acquiring those assets is a cash outflow. Selling them, of course, gives me a cash inflow. When it comes to financing activities, we're really talking about debt and equity. So any transactions involving what I kind of call term debt, I had borrowed $1 million and 6% interest accrues semi-annually. That term debt, the $1 million I borrowed, that would be a cash inflow from a financing activity. Equity transactions would be more like common stock transactions, issuing stock, buying back stock. So we have stock issues that would increase my financing activity cash flows. Stock repurchases would be a cash outflow because the company is buying back its common shares. Any dividends would be negative. We pay dividends, that's a cash outflow. If I issue debt, then that's a cash inflow. And if I repay or redeem debt, that's a cash outflow, right? Sometimes it'll just redeem itself because its maturity date is reached. Sometimes we buy it back early, but either way, that's a cash outflow. When we sell debt, of course, we're receiving cash. As much as these financing activities are ruled by our debt and our equity, investing activities are really all about our long-term assets. And truly, the operating activities revolve around, like I mentioned, in part net income, but also a lot of our current assets and liabilities in order to strip that accrual income out. Now, I want you to know the three different sections. I want you to know some of the things that go in each section because it's important in accounting and finance and really business in general to understand the difference between operating activities, investing, and financing activities. Um, but what is perhaps the most important is what does cash flow from each of these activities reveal, right? So if I have operating activities, this is actually probably, not probably, it is the most examined source of cash flows because this is cash that the company is generating by virtue of its business model. So this one should be most closely tied to net income. If my net income is positive over time, but say year over year for 5 years, but I don't have positive operating cash flows that are correlated with net income, then I have an issue because that might mean that my net income's positive, but I'm not getting any cash. Well, maybe I'm selling to people that aren't paying me back, right? Or perhaps I'm aggressively recognizing revenues that are not being substantiated with a receipt of cash at some point. So it should be closely tied to net income over time. They don't have to be on top of each other because, of course, we're recognizing net income for cash we might receive later. We might be recognizing some net income for cash we received in the past. That is just an instance of accrual versus a cash accounting. But over time, they should move and trend in the same direction. For investing activities, this is not a source that investors or creditors look to for a company's ability to pay. Because with these, we don't necessarily want to see a positive cash flow from our investing activities. Because if we saw one, that would mean we're selling off our PP&E, our investments, our intangibles. It's almost like the company is downsizing and shrinking. Growth of the company would suggest negative cash flows. They're adding more equipment, more buildings. They're investing money in more places. They're acquiring other companies. They are producing intangibles or buying intangibles that will help the operations of the company. So this actually, we kind of want to see investing activities to be negative to indicate growth. Financing activities are seasonal, if you will. If we have a huge stock issue, yes, this will be positive, but companies do not often issue shares of stock to the market. Um, Stock repurchases, what a lot of companies do, will force our financing flows negative, as will dividend payments. When we issue debt, we'll show some cash inflow, but when we redeem it, it'll be an outflow. So, really, the financing activities of the company can go positive or negative depending where the company is. Does it need, if there's a soon to happen growth opportunity, then the company might issue a bulk of debt in order to seize upon that opportunity so that they have the cash to do it. And that would be a positive flow. Well, that's great. But the company may also be in such a position that it has so much cash on hand that it can afford dividend payments to its shareholders, repurchase stock from its shareholders, or redeem some outstanding debt. And that would be good news too. So you know, long story short, positive or negative here, you just got to understand what the business is doing, right? If it has a growth opportunity, it might be financing itself. If it has more than enough cash, it might be paying down some of its prior debts or returning wealth to its shareholders through debt, dividend payments, and stock repurchases. For investing activities, negative flows tend to mean growth. Positive flows tend to mean downsizing. But for operating activities, operating cash flows, we always want to see these positive, and we do want to see them closely tied to net income.